Next up, Mary McWilliams to introduce our main speaker for today. Mary, as you may recall, was a longtime member of our club. I'll call you a friend of Rotary today. She's Executive Director of the Puget Sound Health Alliance. Prior to that, she was President of Regents Blue Shield. Mary McWilliams.
So please join me in welcoming Dr. Williams to address the club on the outlook for the economy and monetary policy.
Thank you, Mary. And thank you for giving me the opportunity to speak here today. I want especially to pay my respects to Admiral Beazle, whose remarks remind us what America is capable of when we face a challenge. And I'm very glad to be here in Seattle, a city known for its excellent quality of life, its natural beauty, and rich cultural resources. Now, this is actually an issue you have to be very careful and very politically sensitive about. You know, I'm the president of the 12th district, which is the nine western states of the United States. So I have to be careful not to say one city is more beautiful than the other, or more culturally, rich, or things like that. And in fact, another challenge I face, which Mary referred to baseball, but I'll talk a little bit about football, is that, you know, I'm from Northern California. I'm a lifetime Giants and 49ers fan. And one of the challenges I face in this job is to be open to the fact that there are other teams in the district. And I've talked in our LA branch and in Los Angeles about trying to come to terms with the Los Angeles Dodgers being a team in our district that I should support, and I'm working on that. But I will say that last year I did take a step in terms of football, and I was rooting for the Seahawks during the playoffs. That was easy because the 49ers have no chance of being in the playoffs either last year or I think this year. But again, I'm happy to be here to talk about the nation's economy and what the Federal Reserve is doing to promote recovery. I think it's worth reminding ourselves that after suffering the worst financial and economic crisis in several generations, we are now in the third year of economic recovery. In fact, I am hopeful that the pace of recovery will pick up over the next few years as the economy heals from the wounds of the housing crisis and housing crash and financial crisis. We should keep in mind that the fundamental drivers of long-run economic health, our highly skilled and educated workforce, our entrepreneurial spirit, and our cutting-edge technology remain intact at present. As I will discuss in a few minutes, to me a critically important goal of policy is to ensure that the economic difficulties we face today do not create lasting scars that diminish our longer-term economic prospects. And I should stress here that my remarks represent my own views and not necessarily those of others in the Federal Reserve System. Although I remain bullish on the American economy in the long run, the fact is that we face very real difficulties right now. The recovery has lost much of the momentum gained early last year, and the outlook for the economy over the next year has grown darker. The GDP numbers tell the story. So real gross domestic product, or GDP, is a broad measure of the goods and services that Americans produce. It grew at nearly a 4% annual rate in the first half of 2010, before slowing to about a 2.5% growth in the second half of last year. Then, in the first half of this year, real GDP growth fell to a scant 0.7%, and that's dangerously close to stall speed. Now, this slow growth explains why the economy is adding so few jobs these days. Last week, we got the employment report for August, and payrolls outside the farm sector didn't increase at all in August in the whole U.S. economy. Indeed, over the past 4 months, we've added only 40,000 jobs per month nationally on average. That's well below the pace needed to bring the unemployment rate down from its current very high level of 9.1%. And I should stress that this 9.1% number understates the degree of difficulties we have in our labor markets. When you count those who want to work but who have given up looking, or those who only work part-time because that's all they can find, the underemployment rate actually exceeds 16%. Now, the recent slowdown was due in part to temporary factors, and the weather was unusually bad in many parts of the country this winter. The Japanese earthquake and tsunami disrupted global supply chains, and perhaps most importantly for the U.S. economy, for U.S. economic growth, oil and other commodity prices have surged. Higher prices at the pump staggered Americans and took a sizable bite out of consumer spending, and this happened at a particularly sensitive moment in our economic recovery. The effects of these temporary breaks, fortunately, have largely faded, but several more persistent trends are impeding recovery today. The news from the housing market has been particularly dismal. Past recoveries typically get a kickstart from a rebound in home construction and spending on furniture, appliances, and other big-ticket items that people need for their new houses and apartments. But this time, though, construction is actually stuck still at post-World War II low levels. A huge supply of homes is available for sale, which keep prices down, and add to that what might be called a shadow inventory of some 4 million homes nationwide whose owners are seriously delinquent on their loans or in foreclosure. Despite great loan terms and low prices, buyers who qualify for credit are understandably nervous about jumping back into the housing market, given recent events. And of course, there's millions of other potential buyers who are underwater on their current mortgages, making it hard for them to sell or refinance. Meanwhile, the bounce in consumer spending, often seen in the wake of recessions, has been unusually tepid this time around. The combination of huge amounts of household debt, losses in the housing and stock markets, and high unemployment has clearly taken a toll on both the ability and willingness of households to spend. People are on edge, waiting for the other shoe to drop. Consumer sentiment plunged last month, which was partly a reaction to the unnerving news about the federal debt ceiling debate in Washington, D.C., and the European debt crisis. In fact, the latest consumer sentiment readings are near the all-time lows recorded in late 2008 during the most terrifying moments of the financial crisis. And here's a telling statistic that tells you where the mindset of the American consumer is. 62% of households expect their income to either stay the same or decline over the next year. And this is the worst reading we've seen on this survey question in the over 30 years it's been asked. So with consumer spending making up about 70% of the U.S. economy, it's hard to have a robust recovery when Americans are so dispirited. Recent developments have raised questions about the strength and the durability of the recovery. But still, despite all these obstacles, the odds are that we will continue along the path of recovery and that the pace of growth will pick up modestly. The temporary shocks that I mentioned earlier have begun to fade, so the manufacturing sector, especially automobile production, has started to recover from the effects of the Japanese earthquake. Oil prices have come down, and importantly, the financial system's health has improved greatly over the past few years. Interest rates are at historic lows, and corporations are flush with cash. And banks are slowly relaxing their grips on loans. So these factors together should lay the foundation for gradual economic improvement. Looking at my crystal ball, my forecast calls for the economy to grow around 2% in the second half of this year and to gain further strength next year. Unfortunately, 2% growth, or even faster than 2% that we're expecting next year, won't be anywhere near fast enough to bring down the jobless rate much. In fact, I expect unemployment to remain around the 9% level through the end of this year and to still be above 8.5% at the end of next year. So this recovery is very different from other post-war upturns, which tend to be relatively vigorous. We're in the third year of renewed growth, and the unemployment rate today is still higher than almost any point since World War II. Shockingly, the economy today has the same number of jobs as it did in February of 2000, more than 11 years ago. And almost a third of the unemployed, that's nearly 4.5 million people, have been out of work for at least a year. A striking break from past downturns when unemployment spells were typically relatively short. And the longer it takes to get this economy back to full health, the greater the risk that the recession will leave permanent scars. As I said, millions of workers have gone years without jobs. They're losing on work experience, and they're losing their attachment to the labor market in general. And my concern is that many potentially productive people could become much more difficult to employ or drop out of the labor market altogether. At the same time, we're vulnerable to negative shocks that could put the recovery at risk. That's why events in Europe are such a cause for concern. Fears that some nations in the Eurozone will not be able to make their payments on their debts have spread from smaller countries, such as Greece and Ireland, to larger economies, such as Spain and Italy. This is not something we can dismiss as somebody else's problem. A full-blown financial meltdown in Europe would hit U.S. exports, which have actually been one of the few bright spots on the U.S. economy. And perhaps more importantly, it could slam U.S. financial markets and deal a further blow to already fragile confidence. Now, we've had our own shock right here in the form of the contentious debate over a long-term fix for the federal budget deficit. Now, I want to emphasize it's essential that we bring the budget under control. But how this is accomplished is extremely important, both for our country's short and long-run health. First, let's look at the long view. The budget decisions made today will affect our nation's future investments in job training and education, research and development, and public and private capital. These are the critical determinants of our long-run economic prospects and standards of living. In the near term, efforts at deficit reduction may reduce demand and further slow the already precarious recovery. In addition, the deficit controversy has added one more ingredient to the currents of economic anxiety that are roiling households and businesses. And as I mentioned before, the short and the long run are connected here. The longer it takes to get the unemployment rate back down and the economy back to full health, the greater the risk there is that there will be permanent scars. Now let me say a few words about inflation. At the end of last year, inflation was a very low 1.4%, according to the Fed's preferred measure of consumption prices. Now that had some people worrying whether we were at risk of sustained deflation, in which prices actually fall. Since then, spikes in oil and other commodity prices have driven up inflation, and over the last 12 months, prices have increased about 2.75%. But I don't expect this inflation bump to persist. The earlier rise in commodity prices was fueled by strong demand, especially in the rapidly expanding economies of the developing world. At the same time, the prices of goods imported from China and other countries rose as producers there passed on their own higher costs. Recently, though, prices for oil and many other commodities have declined, largely due to the reduced expectations for global economic growth. In addition, the price hikes for imports have mostly passed through the system like the proverbial pig in the python. And looking ahead, I expect inflation to ease to about 1.5% next year. This is somewhat below the 2% I see as the appropriate goal, medium-term goal. My expectation that inflation will fall reflects the fact that the economy is performing so far below its potential. Economic slack tends to depress inflationary pressures. It means that workers have very limited ability to demand higher wages, and businesses can't push through price increases that will stick. For example, the latest report showed that wages grew only about 2% over the past year, hardly a prescription for higher inflation. In addition, surveys show that expectations for inflation remain remarkably stable. To sum up, the economy is improving, but at such a modest pace, it will be years before we see a substantial reduction in unemployment. At the same time, we face heightened risks that could cause growth to fall short of even these modest expectations, or even worse, send us back into negative territory. And inflation, which has been running higher than I'd like, is now moderating and likely to drop below preferred levels. So let me turn to monetary policy and what the Federal Reserve is doing to promote economic recovery. Congress has mandated that the Fed pursue two twin goals of maximum employment and price stability. During the recession, the economy deteriorated sharply. Inflation dropped to very low levels. In response, the Fed's policymaking body, the Federal Open Market Committee, or FOMC, took aggressive monetary action. It lowered the Fed's benchmark short-term interest rate, known as the federal funds rate, to close to zero in December of 2008 and has left it there since. In addition, the FOMC carried out 2 rounds of purchases of Treasury, mortgage-backed, and government-sponsored agency securities, bringing our holdings of these instruments to $2.65 trillion. These purchases have reduced longer-term interest rates, thereby improving financial conditions more generally and providing a boost to the economy. They also reduce the risk to slipping into sustained deflation. Despite these efforts, the recovery slowed to a crawl this year. Now, the question for me and my colleagues at the FOMC is, but what does this mean for monetary policy? After all, monetary policy cannot cure all that ails our economy, which in large measure involves the after effects of the mortgage lending boom, the housing crash, and the resulting financial crisis. But monetary policy can help limit the damage and provide some support to other areas of the economy. So I'll use a medical analogy, which I think may be useful. Today's economy is like a patient who has suffered a number of injuries and needs time to heal. For the healing process to succeed, it is essential that the bleeding be stopped, the patient be properly hydrated, blood pressure and temperature properly regulated, and secondary infections avoided and treated. Now, these treatments don't cure the injuries directly, but they do reduce the risk of the patient getting worse and allow the natural healing process to take hold. I view the monetary policy situation as broadly similar. Like the hospital patient, the economy took a turn for the worse and faces heightened risks. In addition, inflation is expected to drift down. So these circumstances called for additional monetary easing. And at our August FOMC meeting, the committee took a step in that direction, in issuing a statement that we are likely to keep the federal funds rate at exceptionally low levels at least through mid-2013. Now, in one respect, this announcement wasn't really such big news. Even before the announcement, financial market participants generally didn't expect the Fed to raise rates much earlier than mid-2013 anyway. But it was news in the sense that it removed uncertainty about what the Fed was doing and helped financial markets better understand our intentions. In response to the FOMC statement, financial market expectations of future interest rates and U.S. Treasury yields fell. And I want to emphasize that we are not tying our hands by making this announcement. We haven't made a guarantee. We will alter our policy as appropriate if circumstances change. But right now, the real threat is an economy that is at risk of stalling and the prospect of many years of very high unemployment with potentially long-run negative consequences for our economy. There are a number of potential steps the Fed could take to ease financial conditions further and move us closer to our mandated goals of maximum employment and price stability. Of course, these treatments won't make our economic problems go away, and their costs and their benefits must be carefully balanced. But they could offer a measure of protection against further deterioration in the patient's conditions and perhaps help him get back on his feet. So thank you very much, and I'm happy to take questions.
On that last point about keeping rates flat, at least to 2013, can you please address the inherent moral hazard and the resulting risk of a carry trade that will ensure that this commercial banker, this commercial lender that was introduced earlier who isn't lending, still isn't lending because they're playing the carry trade instead?
So I'll answer it in two ways. I think one point I'll just make is that monetary policy, by its nature, our one tool is affecting interest rates, lowering interest rates when the economy is weak or inflation is low, and raising them when its economy is strong, inflation is too high. So this is the one tool that we can use to try to help improve financial conditions and boost the economy. And we're weighing how our tool works to our objectives of full maximum employment and price stability. In terms of carry trade or excessive risk taking or other aspects, these are things that we actually in our bank supervision side and also in our financial stability groups watch very closely. From the bank supervision side, we're obviously concerned about banks taking on too much interest rate risk or too much credit risk in response to a low interest rate environment. And from a financial stability point of view, one of the lessons of the crisis was that in this kind of environment, people can take on more generally, there can be systemic risk from excessive risk taking and such developments. So we're watching for those very carefully. I think that the choices we're given in terms of how to try to reach our objectives in terms of employment and inflation, the choices we have are, do we want interest rates to be a little lower or do we want them to be a little higher? And I think that all the evidence we have and our analysis suggests that having the low interest rates through the next few years is the best way we can to help promote recovery. This is Brian.
What do you think will be the effect of last Friday's announcement that the administration is going to sue the major banks and financial institutions for selling Fannie and Freddie poor mortgages?
So I don't have any direct comments, obviously, about that decision. It's outside of our purview. But clearly the health of the financial system is important for the recovery. As I mentioned in my remarks, we need to get, for this economy to improve, we need to get the financial system to strengthen, and it has been. We've seen lending standards improve. We've seen financial conditions we've had some 2 steps forward, 1 step back. I think an important part of our recovery is seeing the strengthening of financial conditions more broadly, but I'm not going to comment on specifically what the administration or any of these legal actions.
We read a lot more today about the differences of opinion of the governors when action is taken. Is that because we're in more uncharted waters than we have been in the past, or have those differences always been so vocal but privately?
So I think there's a number of factors behind. So we did have 3 dissents at our last FOMC meeting, which was the first time we had 3 dissents since 1992, but we have had them in the past. I think there's a number of factors going on. One is we are clearly in uncharted waters. We're in the worst recession going back to World War II. Monetary policy, obviously, with interest rates near zero, it's the lowest they've been since since the World War II period. I think that's one factor. I do have enormous respect for my colleagues and every one of them who is struggling with exactly the same issues I am, but trying to diagnose what are the factors driving the economic conditions, the outlook, and what the appropriate monetary policy stance is. And I have to say we have a very rich debate with diverse perspectives and views, and I think that is going to help us get to the right place. So I think having that differences of opinions, differences of perspectives is really important and valuable. In terms of it being a little bit more in the open, I think that the Fed has moved over the years to be more transparent and more open about our views and what we're doing. And again, given the difficult problems economic problems our country faces, I think greater transparency and openness about these issues is valuable. So that's how I view this. But again, I just want to reiterate, this is a group of 17 people who are working their hardest in terms of the FOMC, figuring out what's going on, what's the right policy to do to achieve our goals.
What is the probability that the dollar will be dropped as a reserve currency by the central banks?
So, the dollar has been a reserve currency for a long time. I don't think that's going to change. The talk before, a few years back, was that the euro was going to replace the dollar. That doesn't seem likely right now. The other major, obviously, other currencies are out there, but the countries that people look to right now as being relatively strong because they're commodity based or they've got their deficit situations in their order are countries like Australia and Norway, countries like that which are not major financial centers. So this may be one of those cases where there's the dollar may not or the U.S. economy and may not be perfect but it may be better than the alternative. So I really don't see a change in that happening anytime soon.
Economics has been called the dismal science. I'm wondering, given the lack of efficacy and even potential harm that's been done by some actions, if you could describe the sense of introspection at the Fed and maybe a sense of humility that maybe we don't have all the tools in monetary policy. And interestingly, you used a medical analogy. Observers of the Fed have considered a patient that may need an amputation, which is clearly appropriate medical diagnosis in some cases, and the Fed continues to minimize the consequences of bad decisions, tries extraordinary measures to extend something, and maybe they ought to let some natural forces work.
As I usually say at the end, don't you agree is the question. So, going back to Mary's introduction, I've been working in public policy all of my career, and one thing this is true of all business people too, when you work in the real world, making real decisions, you have your theories, you have your mathematical models and things, but humility comes with the territory of working in the real world. And I think that one of the things that we've had over the last 3-4 years is many of our assumptions, and I'll say many of the assumptions I had coming out of my experience in the 90s and early 2000s have been challenged. We need to rethink our assumptions about many different things and how the economy works and how globalization changes things. So I think that there's a very healthy, very serious effort among people in the Federal Reserve and obviously academic economists and people around the world to rethink our assumptions, rethink our models, and I think that's ongoing. And I think out of this we'll be better, have a better understanding of the economy and what the Fed can and can't accomplish. In terms of the patient analogy, obviously I wasn't going to mention amputation in my public speech. That I don't think would have been good. But I think that I go back to my analogy, which is that the problems in the economy are not ones. A lot of people say they're not monetary in their basis. They're really out there and problems we have that need to be resolved over time. And I completely agree with that. We're not trying to solve the world's problems. I think it's now becoming a common Fed parlance of policymakers to say monetary policy is not a panacea. I do think that we have to focus on our objectives of trying to keep the recovery moving forward, keep inflation low, and do our job. And if we do our job, that will minimize the spillovers and collateral damage that are occurring from these other more fundamental problems. And I think that as long as we stay on our mission and do the best we can to accomplish that, I think that would be that's the best way we can contribute to helping the U.S. economy. But thanks.
Seattle Rotary Online is made possible in part by a grant from First Choice Health, working with the Washington Health Information Collaborative to use technology to bring better health care to patients throughout the Pacific Northwest. First Choice Health.